All right, so lots of influential factors right now in the markets today, from real estate, what we're dealing with inflation, and also banking issues that really could affect your strategy going forward around crypto or real estate, all those kind of things. We want to bring in a special guest today to kind of break this down. This is going to be a good one. My name is Paul Barron. Welcome back into Tech Path. Joining me today is the Economic Ninja. If you guys don't follow him, hit him up over on YouTube as the Economic Ninja. Great to have you on the show, Ninja.
Hey, Paul, thank you so much for having me on.
So let's get into a couple of topics around the current state of the markets, we'll call it. Some of the things that are happening right now, obviously around jobs. We saw, of course, Kobeisi kind of reporting on this, 150,000 jobs in October. This was below the expectations of 180, and it's likely that this is highly underreported in the sense of real job loss overall. When you look at some of the research and the data that you're doing, I know on your own YouTube channel, you look at the current situation with jobs as they are and where those jobs are coming from, because they're coming from places that are not necessarily even job growth areas. Do you feel like this is a major catalyst for a potential oncoming recession, or do you think this is kind of a natural evolution of these down markets?
Well, you've got a couple different factors at play. One is that the government is not reporting the truth in the way that it should be reported. It actually gives out the facts and figures, but one fact and figure that they really go a little light on is the headlines come out and they say that employment's increasing, employment's great. But what's increasing is part-time jobs, not full-time jobs. When you see, it seems to be right now about for every one full-time job that's taken away, taken off the market, that's somebody that's, fully employed, has hopefully some type of benefits package, has insurance, things like that. For every job that's taken away full-time, we add about 3 to 4 part-time jobs. And a lot of this is because of government overregulation, where governments have stepped in and they tell employers, hey, if your employees are employed at a minimum 30 hours a week, that's considered full employment. So we want you to give them benefits so easily. And it makes sense. Companies go, okay, we're going to start pulling back and giving certain employees like 28 hours a week so that they stay right underneath that threshold. So that's
Right.
one factor that's really not explained very well. Another thing is that the Federal Reserve is hell bent to raise unemployment. And this is what normally happens during a tightening cycle. The reason why the Federal Reserve has to tighten anything is because inflation got out of control. The Fed has always had an inflation mandate. Their numbers are 2%, which we all know inflation runs a lot hotter year after year, over 2%. But again, they're moving these metrics, they're changing the goalposts. And so now that inflation has gotten away, they need to tighten. One of the ways to tighten is to cause unemployment. Well, how does the Federal Reserve cause unemployment? It puts the pressure, turns the screws on to the employer in the form of less money being lent out into the market,
Right.
higher interest rates, things like that.
Do you feel like this is just the beginning of the iceberg in terms of jobs available, true unemployment spiking into possibly some people out there have even pushed out into what we could see if you look back at some of the recessions in the past where we see double digit unemployment over 10%? Do you think that is even possible with the current status here in the United States?
Yeah, 100%. Completely believe that by the time we hit a bottom, we will be well into double digit unemployment numbers. Let's give the car industry as an example. We've seen numerous auto lenders completely pull out of the market. The latest large auto lender that pulled out of the market was Bank of Montreal. Now, if you think about it just from that aspect, that means that there are less lenders lending into the market, allowing people to be able to buy a car. Because most people, and I'll tell you, I've got a car for sale right now at around $9,000. There's not a lot of phone calls. My phone's not ringing off the hook. And the reason why is because people don't have the cash to buy it. They need to finance $9,000. And so
Mhm.
they're having a harder time because their interest rates are so much higher. Why? Well, one of the reasons, not only the Fed raising rates and the bond market going crazy, but also since there's less lenders in the market, a lot of these auto lenders have to take a certain stance on risk, and they go, "Hey, if we're going to loan at a certain amount of money into the market with the certain average credit user or the person that needs a loan, they have a credit score of X or they've got bills of Y. They got to ask higher rates." So the problem is now you've got employment being affected there too, because if there are less car loans going out, there are less auto salesmen employed. There are less people working behind the desk giving those loans out. I know that might seem real small, but when you look at it from a 20,000 foot view perspective, you start really thinking about just one little step where the Federal Reserve makes it so impossible for a bank to loan money to someone. That chain effect, that going down the stair, stepping down from one job loss, two jobs lost, three jobs lost, after a while it starts just multiplying.
So a lot of factors here that you're mentioning, and you look at this because we're talking about potentially still job numbers going up. If job numbers, when I say job numbers in the sense of unemployment, if it does go up, wouldn't that kind of align with what Powell's directive is, which is job loss goes up, inflation numbers start to reduce, and we see what we could see, which is maybe that target of 2%. Do you think that's achievable in, say, the next 2 to 5 years? What is your thoughts on what Chair Powell is looking at in terms of hitting that target?
Yeah, so I actually believe that you're going to see a 2% inflation rate in 5 years, maybe six. And the reason why is because we're going to have an epic crash before then. The Federal Reserve historically does not start touching or pivoting its rates until we see about 20-25% taken off the major indexes of the stock market. It takes a lot more than just a housing correction to do that. If you look back on when the Fed started to really pivot last time was 2007, which was in line with not only a housing correction, but also the stock market indexes started really trending lower. It wasn't until it hit its crescendo between September of '08 and the spring of '09. But you also have to remember, too, the Federal Reserve did not have its repurchase window open until January of 2009. So we'd already seen a massive haircut off of stock market indexes. We saw a massive haircut off of home valuations well before they even opened up the repurchase window. Now, what's different this time is that the repurchase window has been open for quite some time. We have over 700 banks failing. That's from the Federal Reserve, not from me. We are seeing an epic crash in the banking sector, but tying this back into like what you were saying with the pivot and the unemployment numbers are actually showing positive. If people don't really disseminate them, it's showing that employment's strong, but it's strong in the wrong way. We're getting more part-time and underemployed employees, and we're losing these full-time jobs. As a matter of fact, we're already seeing the month of October has been impressive as far as job losses, because we're seeing companies shave 10% of its workforce, or at least they're announcing that they're about to lay off 10%. Even Citigroup came out September and they said, we're going to lay off an undisclosed amount of people, and then we'll really let you know in a couple of months. And the reason why they said that, they're preparing people. They don't want everyone jumping ship. So they don't want everyone to know exactly what they're doing. But at the same time, they're trying to appease their shareholders because they're trying to keep their shareholders from selling their stock. And they're saying, hey, we've got a plan. Don't worry. Everything's going to be fine. Very similar to what happened with WeWork. WeWork gave you the idea in the last couple of months, hey, we don't see ourselves really going forward in the normal direction. We're going to have to start talking to our creditors and starting to try and renegotiate leases. And now you find them in bankruptcy. So we're in that situation where CEOs are trying their hardest to keep their shareholders calm. We saw that with Lowe's and Home Depot back in the spring, where they said the consumer has changed. And they're trying to give you very interesting ways of wording or wordsmithing. Please don't panic. Don't sell our shares because we're essentially screwed right now.
Some of the things I want to kind of point to: Fed has lost control, bank collapse, commercial real estate disaster, pension fund devastation. Something is running up quickly. This is kind of the topic around what's happening overall. And then I want to play a clip from Peter St. Onge on what's happening in Switzerland. Let me just jump to this clip real quick and let you listen in.
In an ominous sign for our coming financial crisis, Switzerland is considering locking people into failing banks using capital controls that would stop depositors from withdrawing their money. I talked about this in a previous video, so-called friction tech, that would lock depositors into dying banks, forcing them to go down with the ship so no banker is left behind. The Fed has also been pushing such controls in a series of papers ever since Silicon Valley Bank went down back in March. So specifically, Switzerland's considering limiting withdrawals to 50,000 Swiss francs per year. Franc is about $1. Larger withdrawals would be subject to a 3-month notice period, so you'd have to wait 3 months.
I'm going to pause it there. So it isn't, in fact, taking place in Switzerland, but they're looking at doing this. Remember, if you look at the European Union, about 6 months ahead of us in terms of the economic cycles, and they're obviously already in a recession. If something like that, if the Fed were to come in and put those kind of controls in to kind of avert what happened at Silicon Valley, how do you think consumers would respond to that? Retail, I mean, because everybody's already on edge with this, and now I'm going to have a limit on what I could pull out of my bank. What are your thoughts on how, Americans would say, okay, we're okay with that?
This has actually been happening for over a decade. We've seen times of banking crisis, and I guess the ruble would be one of the most recent examples. And there was some examples in certain Slavic countries where they were told that they were only allowed to withdraw a certain amount of money per day when there's an actual banking crisis. And it's happening in America right now in cryptocurrency. If you have a Coinbase account, if you deposit some money, wire it that day, it shows in your account. You could buy Bitcoin with it all day long, but you can't withdraw that Bitcoin for 72 hours. It's because they are insolvent. That's a derivative. And most people don't understand how that works. And so these are great signs when you see countries start to say, hey, we're looking at doing this. Or you look at what's just going on with Bank of America and some other key banks just a few days ago where they had a quote unquote glitch. And I'm going to tell you, this is sort of the conspiracy theory side. I don't believe that these are glitches that just accidentally happen. There are some that happen, but it's also a test to see how depositors react. And that test was a few days ago. Your deposits were coming into your bank, but it might take a day or two or maybe 3 for you to be able to access that money because there was a glitch. And really what that is the ability for bankers to be able to see how the public reacts to such an event. And those are things that I'm reporting on all the time. I'm sure you are. And I think people need to take heed. So what can you do? First thing is separate your risk. And that is big multinational banks, local regional banks, and credit unions. But then also, you don't have to have all of your finances in paper as well. You could actually get alternative assets.
Yeah. Talking about alternative assets, digital, especially when we talk obviously about crypto quite a bit here, you look at what's happening in the ETF land. Now, many people say, okay, well, that's kind of structured capital again, but it is ETF. Likelihood is we're going to see a lot of impact in crypto in general, Bitcoin, Ethereum, many of the traditional digital assets most likely to move. When you're looking at a balanced portfolio in the oncoming, whether we see a full recession, we see a bank reset, all sorts of things that could happen, how would you balance this out beyond just having a multitude of bank accounts? Would you go into, alternative assets, gold, real estate? Where would be your mix?
Okay, so first off, I want to say that no cryptocurrency is immune from a stock market crash. Every time we see large stock market corrections, Bitcoin and other cryptos sell off. So people have this idea that we're going to see this massive divergence one day. That could very well happen, but the problem is every time it seems like a big hit to the stock market happens, that same hit happens in crypto. Why? Because the amount of leverage. So people need to realize that. Number two, when you're talking about being spread out and diversified, I have about 5 different, I call them bags, right? Because we're always the bag holder until we're not, until we sell. I like to have the investments that I make, whether it be gold, silver, Bitcoin, real estate, I want to have the fundamental belief that it's going to go up in the future and why. Most investors are not investors, they're speculators. If I was to ask most people, why do you think Bitcoin's going to go up over the next 10 years? They really couldn't give me an example other than, well, it's just there's only so much of it. Well, there's an adoption rate, there's technological advancements, there's government security or insecurity, whatever way you want to look at it, what they want to do. Just look at the SEC and XRP right now. But my point being is that most people don't understand the basic fundamentals. Once they do, what I do is I simply spread everything out equally, my assets. And then as one goes through a bull run, I take profits off and I put it into another bag that I still have fundamental beliefs on, but it's just in a cold sector right now. And that's how I personally do it. It's not financial advice, but I think that most people, once they start to figure out the real true fundamentals of why markets or assets go up and down, they'll really have a lot more conviction and they won't be afraid when something goes down. They'll be more excited to be able to buy more of it.
All right, so let's, I just want to run a scenario past you, last question, and that is, the cycles that we're dealing with, potentially a down cycle on traditional securities. Most likely this is going to hit the commercial market, real estate market. There's going to be a cycle where this is a great time to get in. And these are when millionaires are made. Same thing will happen most likely in the digital assets side. So let's say that we are on the other side of this recession and you're looking at these potential markets, whether it's real estate, digital assets, traditional, whether it's, precious metals or businesses. How would you play that coming out of that? Because that's going to be really kind of the opportunity of where we're going to see an uptrend in the markets.
Yeah. So no matter what you're talking about, whether it be stocks, crypto, real estate, any asset class, there's a point where there's just maximum hatred, maximum doom and gloom. Nobody wants to touch them. I'll give a Bitcoin example. My first run up for Bitcoin, I bought my first Bitcoin at 500, sold some around 16, 17,000 because I figured it was getting frothy. By 19,000, we saw that dip, but that was when everybody was excited about it. By the time it went down to the $3,200, $2,800 range, everybody hated it. And I was excited because I was rebuying. The same thing with real estate happened in 2010, 2011. Everybody hated it. It had been going down for 4 to 5 years and nobody wanted to touch it. The business cycle, everything is the exact same way when it comes to investor, sentiment. When you want to start buying is actually right about the second quarter that the Fed starts to pivot and starts to lower rates. And the reason why on certain asset classes like real estate, as real estate goes down, as long as you could buy right, and I'm not saying you just go buy real estate to buy real estate, but as the Fed starts to pivot and lower rates, if you can find something that's renting properly, 1% to the purchase price of the property, and I know it sounds crazy, but it happens every 7 to 12 years where you can find a $100,000 property renting for $1,000. The reason why you can do that is because there's less buyers and sellers, because most buyers have exhausted their available credit because their credit score is screwed up. They're emotionally messed up in the head, and lending has gotten tight. Well, as the Fed starts dropping rates, you have a very small time to actually start refinancing. On the lower side, if you bought the property right, it's cash flowing, the cash flow is going to explode. And then what you do is you take that bulk money and you move into businesses. And the reason why is because it takes a certain amount of time for bankruptcies on businesses to flesh themselves out. There's companies, a lot of companies that go through multiple bankruptcies over a 2-3 year span during a business cycle as it implodes. And so when you can go in and buy inventory like I was doing in 2012, 2013, and then take that inventory and sell it into the market. Most people have no concept that even during the Great Depression, unemployment was 24.9%. That means 3 out of 4 people are employed. Now, that was the worst ever. But my great-grandfather became extremely wealthy because he was always meek. He always saved and had money on the side. He owned his farm cash. And when all of his neighbors lost their farms, instead of the bank going and buying them, he went and he negotiated with the banks. He bought them and was able to employ all of his neighbors and friends. There is so much opportunity. During the Great Recession, I made so much money because of being able to pivot. And that's another thing most people don't realize. They think that if I'm in business doing the same thing for the next 40 years, it's a good thing. It's really not. You can only be so good by yourself or with a team the size of X, whatever it be, 10 employees, 100 employees, until you take it and you move. And most billionaires made their money by pivoting. They made it in one company, then they took that money and made it in another company. So I think that's the real message here is when the Fed starts to pivot, that's when everything has broken. And that's when everyone loses their mind. And you have a very awesome opportunity about a couple of years to be able to take advantage of that fact that people are losing their mind. And again, just on the way up where they think everything's going to go up, houses aren't going to drop, or the real estate market's not going to drop, stocks aren't going to drop, it's going to drop. And when that happens, that's when you're buying up assets for pennies on the dollar and get ready to sell it back to them on the next cycle up.
Yeah, I think, we talk about this often is that these corrections are all cyclical. They usually are driven off of macro pressures, which continues to be at full tilt right now, all the way into what we're dealing with just international conflict. So I would agree with you. Economic Ninja, great to have you on the show. If you guys have not checked out his channel, go over to Economic Ninja on YouTube. You'll catch some of the things he's doing out there. Thanks a lot for stopping in. We appreciate it.
Thank you. Have a great day.
You bet. All right, so guys, if you're listening in over on the podcast side of things, make sure and jump over here to the YouTube channel, get a full experience. Of course, if you're not in our Diamond Circle, make sure and get in on that now. It's additional content for you, and it's very easy to join. Just click the link down below. Catch me out there on Twitter at Paul Barron. We'll catch you next time right here on TechPath.